Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. If you're enjoying the podcast so far, smash that subscribe button on Apple, Spotify, YouTube, and make sure you never miss an episode. On this episode, we've got Liz Miller of Summit Place Financial. Now, she's saying this is definitely a time to be cautious in the portfolio, but guess what? She's out there buying stocks, some that are down as much as 30 and 40%. Let's find out what those names are. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. If you're looking to build a portfolio based on in-depth analysis and long-term strategy, you understand the power of informed decisions. With BMO Investor Line, you get access to a wealth of research, market insights, and educational resources, including the BMO Investment Learning Center. Open a new BMO Investor Line account and you could receive up to $3,500 cash back. It's a great way to jumpstart your investment plan. Learn more at bmo.com/online investing. Liz Miller of Summit Place Financial, thanks so much for being with me.
Thank you, Amber. It's great to join you today.
I've always enjoyed our conversations over the past couple of years, and you have such a breadth of experience. How long have you been running money?
So I've been managing money for a little over 20 years, first in the mutual fund industry, then for institutions, and since I've had my own firm now, over 15 years.
So that's great because that spans a bunch of market cycles. And right now we're in a market cycle that is definitely a downturn when it comes to U.S. stocks. What's your read of the situation, your lay of the land? What's your bent? Do you get defensive in periods like this? Do you back up the truck to buy up oversold names? How are you thinking about what's going on in the markets right now?
Well, one thing I've seen over those 20 years is that market reactions today are really different. Like we see some of the data coming out, consumer confidence, activity, and the reports are saying it's as low as it was in COVID or it's as low as 2008. And I don't think the fundamentals are anything like that. So the way we manage assets has to adjust to an environment where both information and reactions are quick and extreme. So it does lead to needing to step back more. In other periods of uncertainty and volatility historically, we would be collecting a lot of data moving forward. And we're doing all the data. We certainly have our wish list. We're reviewing holdings. But this is an environment where the fundamentals are still incredibly unclear. And I don't think you get rewarded for being part of that really fast pendulum back and forth.
Let's talk about those fundamentals. Obviously, it's all around tariffs. As it pertains to how you do your homework, right? You're trying to figure out how much profit is a company going to earn this year, next year, the next 5 years, and then you figure out what's the value of this company relative to that profit outlook. I imagine that understanding what that profit picture is going to be even next month just got super complicated.
It did. And we're right in the middle of earnings season, and I think we're going to hear that all over the place. This week is the peak week for earnings, and I don't think the markets are going to be moving on what they hear because they're not going to hear much. Corporate executives are going to be really reluctant to give any guidance. If they give guidance, it's going to be very short term, and they're not going to be talking too much further than saying what activity looked like for the last 2 or 3 weeks. So as we look through all our companies, the kinds of things we're looking for are what have been the unit trends or whatever the major driver of revenue has been, even looking back last quarter. So we get more of a longer term macro secular view of the company. We're doing a lot of looking at globalization. Which of our companies are more domestic? Which companies are global? And what are their sources of income and supply as well? Those are the big things you can start laying out when you're talking about a tariff environment. But the bottom line is everything going on right now is about uncertainty. It's not about assured tariffs where we can start calculating results.
And do you think that if there were assured tariffs, is that part of where the uncertainty is? Like, if you knew tariffs were going to be in place, would it be kind of easy because you'd screen out the names that are penalized by it and go all in on names that benefit from it? Is the uncertainty that you don't really know, are the tariffs on or are they off? What's the situation?
Absolutely uncertainty. Because if we knew it, we would take the steps you mentioned, but we might even stick with companies that are going to be hurt by tariffs. President Trump put a number of tariffs in place in his first term, and we all went and said, okay, well, what is the hit? Looking back at 2024, we had an incredible year in the markets, but it was partly retracing still the 2022 pullback. It took 2 years for a lot of areas to pull higher. Now we know tech and Mag 7 really excelled last year and went even higher. But when we look at what the markets did through last year, we knew we had a fully valued market. We were in the camp that said we didn't think we had a bubble, but we said we certainly have a fully valued market that is discounting absolutely nothing going wrong. So if tariffs were a sure thing today, and they will be when this is all negotiated and we know what will happen, we do expect that company valuations will change. And they've already changed. And in a lot of cases, they may have already changed too much. But you do adjust for a different business environment. But once you've made that one-time adjustment, then everything moves forward. So a company is going to still be making widgets, selling widgets under a tariff regime. It's just going to look a little different. And so it's really about that certainty to make the analysis, expect the one-time adjustment, and then decide what does the growth look like from here going forward. And our problem right now, as you noted, is we can't do any of that analysis. So we're seeing valuations, good companies, weak companies, just bouncing all over the place and probably being overly hurt for what the eventual reality will be.
So, like, how does that manifest in the portfolio? And we're going to talk specific ideas, but I want to know, like, literally, does that mean, are you holding a tremendous amount of cash? Did you sell positions? Are you defensive? Like, what was the last time you even bought a stock?
So we just bought several new positions on the really down days the other week. So pretty much at the bottom, we added several new positions that have been on our watch list. Those may not be the bottom, but we initiated new positions. So we've been doing both. We certainly have been having our list of names we've always loved, but we didn't like the valuations they were at, and names we thought were getting overly punished for what the eventual reality might look like. We had been emphasizing even into this year more exposure to companies that are more domestically oriented. We knew that might be something we would care about. Really, since most of our portfolios are with individuals, the other thing we did the beginning of this year is we took a lot of profits in some oversized positions that we were holding off on for tax purposes last year. When you're managing money for families and individuals, you have that extra overlay of taxes. So we certainly were managing risk and taxes into year end. When we took those profits early this year, we did allow cash to build up because we knew we would be going into some uncertainty. So we've had higher cash. We've been buying names we've liked. We made year-end adjustments to sort of increase domestic exposure. But a lot of the portfolio we looked at and said, the reasons we own these companies and the 3 to 5 year trends we liked are likely still in place, and we're not making changes until we have a lot more facts.
So I wonder if that's almost the easier thing to do relative to the other part of managing money is dealing with the clients, right? Like what would you say is the tone and the tenor of the conversations you're having out there? Are they panicked, or is there a willingness to ride this out?
We haven't had any clients that are panicked. We certainly have clients that are, you know, concerned, as they should be, particularly those in retirement or those getting close to retirement or those who were looking at big purchases and are saying, the environment doesn't feel right. So a couple clients looking for homes and thinking about new real estate, and their timing on that will probably get pulled out. They're not saying we're not going to do it, but they are stretching that out. So we're making sure we protect those expected purchase assets. We work really hard to talk a lot with our clients about long-term goals and staying on top of those long-term goals. The other thing we do is in times like this, we make an extra effort to communicate a lot more. The number one thing I hear from people I speak to who are, interested in our firm or coming to our firm is not that their previous relationship has done poorly. More times than not, it's we're going through this incredible time and I haven't heard a word. My advisor hasn't called me, hasn't picked up the phone, hasn't sent an email, isn't doing any communicating. So one thing we try to do very proactively is reach out to our clients and really share what we're thinking, hear what they're thinking, give thoughts. Our clients are as frustrated as anybody with the general uncertainty in life right now. Their portfolio is only one piece of their, frustration and sentiment right now.
I think that human touch is super interesting in this world where we think AI is going to come in and take over everything. So we'll tuck that anecdote away maybe for another time when we're exploring, the power of AI. We're going to talk specific stocks, but before we do, you mentioned that uncertainty. One of the things that is roiling markets this week is the uncertainty around the central bank, the Federal Reserve in the U.S., and open expressions of dissatisfaction by U.S. President Donald Trump towards Fed Chair Jerome Powell, even open musings about firing him before his post expires next year. And that's roiling confidence, right? Like that's a pillar. That's a pillar of certainty is who the Fed chair is going to be and that he can't be removed for political reasons. As an investor, how do you think about that thing?
So as this year started, we knew that Jerome Powell was not beloved by President Trump. He made that clear coming in that Jerome Powell wouldn't be his pick. For that reason, we thought the Fed's power was really diminished right from the start, that there was a feeling, even before any of this, that our Fed didn't have not the same independence that we believed in, but the same kind of power that generally they have. Personally, I think it would have been very good had the Fed, lowered rates in the last meeting just a tiny bit. I don't think a quarter point drop right now is moving future inflation one way or the other. If tariffs come in, yes, you can have a bounce in inflation, but it's generally not a trend. It's usually an investment. And after that, you get more worried about disinflation and a weakening economy. So a preemptive cut would have looked really good, not just for the markets, but for the confidence, I think, of businesses across the country. Our open market committee, Fed Open Market Committee, chose not to do that. Having not done that and continuing on this view of we will only be data driven, which is a very backwards looking view of the Fed, then the Fed is in even a tighter place. If the Fed were to do anything now, they would have no credibility because the president has pushed for it. If the president does remove our current chair and put someone in, that leader also will have little credibility. So I go back to my belief at the beginning of this year, which is we're in a period where our Federal Reserve just doesn't have much power at all. Even as they stay independent, traders are not looking to our central bank for their leadership. And we saw that in a lot of the movement in the bond market after tariffs. If you look at long-term rates, what's really happening is institutional bond traders are making the call on rates and our economy, not our Federal Reserve right now.
And those rates are going higher at the same time that the U.S. dollar is plunging to a 3-year low. How do we square that?
Well, I think the dollar is a short-term reaction. Again, it's this incredible uncertainty. It's bold statements about the U.S. dollar doesn't look like a reserve. The rest of the world isn't going to buy as many treasuries. What happens with that? And both the dollar and U.S. treasuries get caught up in a complicated calculation right now of our continuous deficit spending. So is it a call on tariffs? Is it a call on proposed budgets and spending? Is the rest of the world saying, you can't raise enough money with tariffs to keep pushing out spending every year more than you're taking in? So it's not a specific answer, but just a point that there's so many layers to how both how the rest of the world right now is viewing our dollar and our US Treasury market, which has usually been such a solid piece and a place that the world went when they needed stability. I think the volatility right now is short lived. I think the dollar will find a stable place higher.
All right, well, let's hold on to all of these themes and weave them into some stock specifics and dip into the mailbag. Our first question is on Netflix. Actually, Netflix just delivered strong results. It doesn't appear that the company was affected by Trump's tariffs, and I'm seeing a lot of analysts call this a recession-proof stock. This question is from Fred in Ottawa. Would you buy the stock here, or do you think it's too expensive?
Netflix is certainly fully valued, but it was a wonderful quarter. Now, remember, they're going to stop reporting subscribers, which they did, but because it's the first time they've done it, a lot of analysts are trying to figure out what might have happened. And some actually think subscriber growth did slow despite the great quarter. It is, mostly domestic focused, though it does have a global footprint. Streaming is still very strong in the United States. I would say it's mid-trend of that move away from traditional outlets of media to the full streaming. So I would say you're paying up to buy it today, but I do think there's more future upside for all of the players. Netflix may be a little bit further ahead at the moment, so I would keep an eye on expecting names like Disney and Warner Brothers, which are probably undervalued, to have their day going forward as well. The whole trend in the streaming looks a whole lot like the move to cable in the 90s. And ultimately, once everyone figured out the winning players and got their piece of the pie, they went back to looking like utilities as well.
So that's interesting you brought up Disney as potentially another play on streaming, because while Netflix is just a few percent away from its highs, Disney is trading around multi-year lows. And you've got the streaming business, which was a bit of a problem child because it wasn't profitable, though that's turning around. Now you've got anxiety over the parks. Are you saying you would prefer to buy that weakness in Disney versus allocate new dollars to a fully valued Netflix?
I would today, if you have a several year outlook. I think that Disney has tremendous assets that are undervalued and not coming through. Yes, there's work to do on streaming. I think the streaming is actually in pretty good shape. It really suffered sort of from early expectations and a push by the previous CEO to kind of try to make it front and center. Like everyone, they're figuring out the mix that works best. You have a lot of assets across Disney that get lost when you roll the whole thing up. The parks are somewhat at risk, except we know that they're at full attendance. I mean, if anything, they've been trying to manage the population and the flow into parks with that ever increasing price that we keep getting criticism for. Their challenge is they've tried to raise the price to limit the crowds, and it's still not working. So I'm not saying that the assets at Disney don't all need attention and improvement, but they're not firing on all cylinders. So you have a lot of upside there. Whereas Netflix is doing everything right. And what you have there is more risk to downside if they stumble.
Okay, let's move on to the second question. Netflix actually isn't a Mag 7 stock, though. Its stock has been magnificent and it's outperformed. One stock that is a Mag 7, though, is Google. And we got a question from Instagram. Where do you see Google going in 3 years? And this one, it can seem really attractive, right? You've got this big tech company that's trading at such a seemingly cheap valuation.
Yes, Google is one of the names that we recently started buying. We haven't bought full positions. It's a name we've liked a long time, but didn't like the valuation. And so, as you've said, it's at a depressed valuation. It's at a depressed valuation for a reason. We just heard we might have, an anti-competitive suit over ads. We might see a push to break up some of the businesses. But Google has a lot of valuable assets there. With a 3-year time frame, I think it's a very good buy right now.
So there's the regulatory side of things, but then there's the AI side of things. And, is ChatGPT and, DeepSeek and all of those AI related search bots, going to disrupt Google in the long term?
I think to talk about AI's effect on these companies today is still a little early. I can't help but put it in perspective of the dot-com wave and the explosion of the internet, having managed money through that. I think AI is a complete game changer. I am totally bought in. We have exposure in a number of different positions that we own, but it's something where uh, enthusiasm from investors is sort of getting ahead of the reality. And we keep seeing that. Investors want to hear big investments, but then 6 months later is when they don't see results right away. They're saying, what are we getting from AI? And these things take longer than that. We remember the launch of the internet and what .com companies were little darlings at first and then went completely bankrupt, frankly. I'm not saying we're going to see that with AI at all. What I'm saying is, even with these exciting, transformative um, innovations, it takes time till we see where they're going to flow through completely. And sometimes where we see them first isn't where we expect. We're going to talk about that when we get to the stock picks, actually. Someplace where I think we're going to see the effects of AI earlier than with a Microsoft or a Google, where we see a very visual race right now.
I can't wait for that, and I'm sure our viewers can't either. I'm a shareholder of Google, and so I try and figure out, how much of that AI piece is disruptive versus like another leg of growth for the company. And I was talking to a girl in high school who said she uses ChatGPT for her homework, not to like cheat or anything. She uses it to generate practice questions. She says ChatGPT generate, 10 practice questions along this line. I thought that just kind of blew my mind. Then I was at an Easter dinner where I was telling someone my age what ChatGPT was. So there's still a big generational maybe gap in how ChatGPT is used, which makes it kind of hard to understand where, to your point, where is this thing and how big is it?
Exactly. And there are people using it in so many exciting ways. And we know it's going to be a game changer in many things. But at the moment, we're still talking about, a large language model, which means if it hasn't already been written out there, ChatGPT isn't really going to create something new. So it's perfect for test questions. It's a great way to get a summary of a book or the latest news. We use it to get regular little updates on economic reports that come in so that we quickly kind of get a view of what's happening. And it's perfect for that because the economic data has already been released. There's commentary with it, and probably a couple of news sources have already put something out. So it quickly gets summarized and sent right to my desk so I get a quick view of what's happening on something. But we're not yet at a point where it's, doing vast calculations or doing anything math related or, doing a lot of different things. Generative AI is very exciting. It's still being refined.
Okay, so interesting. You were nipping away at Google there, kind of a low valuation stock. Let's kind of switch industries and talk about Costco. Do you think Costco is a solid recession hedge? The stock appears to have weathered the storm so far, and I don't know where else we're paying 50 times earnings for a retailer.
That is true. And we are owners of Costco, and we bought Costco like in the 2022 downdraft. So our investment approach is rather contrarian at the start. And then we'll hold things a very long time. I cannot justify Costco's valuation. I'm not going to try to. But fundamentally, it has a lot of business practices that make it very attractive right now. It is primarily a U.S. consumer. While it does source all over the world, it does have supply power. It keeps a limited number of SKUs actually compared to some of big box retailers. That gives it even more power with some of its suppliers. So at the moment, it looks like a company that can weather some uncertainty from consumers better than some other companies. I think that's the best way to position it. I don't think you can say that any big retailer is going to come out better off at the start of this. Consumers already are reluctant in their spending, and depending on costs going up, they will adjust what they spend on.
So, I mean, when you talk about these high valuation companies, even though they're well managed, there are some pretty big risks on the horizon, tariffs and supply chains. You know, maybe in a year or two, they'll be able to deal with that, but they might take a hit near term. But when a stock is so highly valued, even that near term hit, you can hit an air pocket, right? Like, what kind of risk do you think exists for Costco in that vein? And like, do investors need to be prepared for maybe a 20% pullback just on valuation alone?
Absolutely. I mean, you nailed it. I was about to say, you can expect to be down 20%. And that's why even when we're talking about these, I'm doing a lot of saying, in an environment today, if you're looking at your current holdings or new holdings, you have to say to yourself, can I hold it for 3 years? Can I buy it and hold it at least 3 years? We opened this conversation talking a bit about these extreme pendulum moves we get more so than history. And 20% is one of them. We know that historically we said 20%, kind of hit that bear market beyond correction, but we're seeing those more and more often, and we're seeing them rather short lived. We don't know if this one will be short lived because we may have continuing uncertainty with these tariffs that pulls this out a long time. But we are seeing that these kinds of moves can come very quickly and can reverse just as quickly. We're seeing it today in the market where we're seeing stocks, every day these days, down 8% on the day. 5, 6 years ago, we never would have seen that much move in an individual stock so much. That would be really unusual. Now it's pretty common. And the next day, we see stocks up 12% in a day. So we're definitely seeing more extreme volatility driven by fast news, computer algorithms that get involved in the market, and big institutional players that move a lot more quickly than we used to.
And I guess if you have that long-term horizon, your view is that smooths out over time.
Yes.
We're going to take a quick break and dip back into the mailbag. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, our next question here is about Sweetgreen salads. The stock is down about 40% year to date. I know you've liked the stock in the past. Do you still like it here? This one coming from Barb in Sault Ste. Marie. Was this an IPO, 2021 IPO story?
It was, and we have owned it for a while. We still own it. And the value was starting to come through last year. It had a tremendous year. And the stock is back to trading kind of where it was right at the IPO. And I think the first thing you have to say about Sweetgreen is that, this is a fast food outlet. A little higher than fast food, but it is generally that. And whenever you're looking at these concepts, when you fundamentally think they're attractive, the most important things are going to be new store openings and same store sales. And you're going to be watching that closely for a number of years. So they were hitting good same store sales last year. It looked like things were clicking in. And, they didn't have a great report at year end and the stock started coming down. Certainly vulnerable to spending for some populations. But here's the two unique things about Sweetgreen. If you've never been to a Sweetgreen, there's a couple of them where I live, and they're very fresh food focused. And so, particularly in urban areas where you have people who are looking a lot more for where can I grab a bowl, a salad. Sweetgreen is known for using a lot of local produce where it can and provides, a very different kind of experience than a Chipotle, which we also own, or even a Cava these days. It's a very fresh food choice, very big with next gen and even with anyone who's health conscious. So first of all, you do have a unique concept. But secondly, the big thing that's being watched there is that Sweetgreen, right from the start or pretty close to the start, has been experimenting with basically a robotic approach to its serving. It has prototypes that can take an order, go to fresh food, and put together a salad or bowl in the exact right amounts and deliver that out. So you have huge labor savings and you have a lot of efficiency. Many investors in Sweetgreen are investing in it for the promise of that. If they can roll that out, prove the concept, it's going to be a game changer across the entire fast food restaurant industry.
So, kind of a trailblazer in tech. And yes, the stock has pulled back, but to be fair, all restaurant stocks have pulled back. Even Wingstop, that seemed like unstoppable
Right.
as a stock, has pulled back. Chipotle down, Cava down, McDonald's down. This as a category, investors are nervous about consumer spending. And it sounds like you're willing to go in to this environment.
Yes, we are. Again, I always remember, I think picking up Starbucks in '08 or '09, we bought it. And we would talk about how, of course, in times of uncertainty, the first thing you cut out is your daily cup of coffee that costs $5, right? Or $3 back then. But it's also one of the first things you go back to when you get a little confidence. And that's going to be the case across all of these concepts, and particularly the ones that are a little more unique. We certainly may see a slowdown for the next quarter or two, but once consumers feel a little more stable, they're immediately going to go back to their favorite, somewhat inexpensive treat of a Sweetgreen.
Let's talk about gold for our next question. This one coming from Jerry in Eagle Bay, BC. Do you think gold will continue its run this year? And do you have a favorite gold stock?
So the first thing I'll do is answer the second part of that. We own gold in the ETF, the exchange traded fund. And I do think that's the best way to participate. And I just had this conversation with my strategist the other day talking about the gold miners. So I will openly admit I am a little jaded on that. I have owned many of the gold miners over the years at various times. And as the exchange traded funds really exploded in their availability and the way the gold ones work, I really realized that I was getting the value I was looking for more out of owning the exchange traded fund of the commodity than the miners. So I haven't been in the industry of gold mining in a long time. I get my exposure from the exchange traded fund. Having said that, yes, it's been a tremendous run. It's interesting that we started our conversation talking a bit about the dollar today, because gold and the dollar have long been havens of safety. And what we're seeing is it's really a haven of safety now. And we do know central banks have been part of the driver of gold. We always know that some of it is coming out of India and the Mideast of demand for gold. And then we've got a lot of people who are getting onto gold because it's done so well, are sort of, yes, safe haven, but also momentum investors. One statistic I read today that was interesting, though, was one that looks at the historical movement of the value of gold to the value of stocks and as a ratio. And what is interesting is, despite the move in gold, when you look at it as a ratio to the move in the S&P 500, it's not out of line historically. Gold really did nothing for a number of years in the middle there, and now is coming stronger again. So that gives me some confidence just in terms of total investing of money going into gold investments versus stock investments. I think we're still in a reasonable place. I don't expect huge upside in gold, but I will openly admit I didn't expect the upside we're seeing. I do always think it's a very good trade when you see investors looking for safety.
So you continue to own gold here. It's interesting you say you don't go to the miners. That's what some people say is the bull case, is that people still under-own these gold stocks, and that they are not fully valued relative to the run-up that we've seen in bullion. What do you say to that?
I say that I agree with that statement, and I've lived it for a good part of my career. And my conclusion was I never saw the value of the commodity come fully through the gold miners. So I think that's a very true statement. And personally, I've lived that statement more than once in my investments. And as I said, my conclusion was to stop owning the gold miners and own the exposure to the commodity itself.
I wonder if we could easily, and we know that you laid out what the bull case is. It's a haven trade. There's been central bank buying. And I'm wondering, your comment about what's the first thing you do when things start to get a little better? You maybe go back to Starbucks. So what's the first thing people are going to do when there is a little bit of tariff certainty? And let's assume for this exercise, there will be at some point. Is that the bear case for gold? Like the minute certainty comes back to the market, gold is vulnerable?
Historically, I've seen it more stabilized than have a quick move down, but we've talked about the volatility in these markets being so extreme. So, nobody could be surprised at a big move down in gold. Since so much of it has been pushed partly by central bank buying as well, I don't think you would see as fast a result, but you certainly would see money come back out of gold and into other investments that promise higher returns.
Our next question is about Berkshire Hathaway versus BlackRock. Both are owners of multiple companies and could be a good barometer for the economy. Do you have a preference? This one coming from Kevin on Instagram.
Well, we are owners of BlackRock, so that says it all, though I do think BlackRock keeps evolving. It's an interesting observation. Berkshire Hathaway is a tremendous stock and always has been. But I always say it's really been a mutual fund. You're really owning a lot of different investments in there, as well as some pretty interesting, sophisticated investments. I mean, Berkshire Hathaway has always done lots of hedging. They've always done lots of structured investments around their holdings. Clearly, we get the most focus on them being big holders in companies over times like Coke and Apple and some of their latest moves there. That's what gets all the attention. But it's a very sophisticated investment strategy. So to me, you're really owning an actively managed mutual fund that has done tremendously over time. We haven't owned it in our financials because I just like to own more specific exposure. When I want to be in banks, I want to be in banks. BlackRock has long been an asset manager, which is the main reason we were holding it. And more, they're getting into trying to democratize many different kinds of private investments for the retail market. And I do think the market is moving that way. So I don't think they look the same under the covers at all. BlackRock still relies hugely on assets under management. It is, I'm going to forget the exposure, but it's 20 to 30% of the revenue is from that. Very different than a Berkshire Hathaway. So I do think BlackRock still firmly belongs in the, financial sector more as a investment manager than something like a Berkshire Hathaway.
BlackRock's pulled back about 20% from its peak. You'd buy that?
Yeah, I shouldn't be. We hold it in a pretty full position because it's done so well. I am buying it fresh for new clients, though. Also, in this environment, just sort of admitting, we're buying things slowly. We're waiting for the market to see what it does, but absolutely immediately buying exposure to BlackRock. We own BlackRock and Blackstone for full disclosure. In similar kinds of companies and some similar kinds of work. Blackstone's certainly more aggressive in the private and more their own investment, less of the assets under management strategy.
Blackstone is also pulled back and, valuations get crushed in the public markets. They also get crushed in the private markets, but they don't have the same benefit of liquidity.
Correct. And we're seeing that everywhere. And it's interesting that BlackRock made the move to more private opportunities when it did. And I do think it will take a little while for that value to come through. For the families we work with, many of them, like private investments, have had it as a part of the portfolio. But certainly, even the last 18 months have been a cautionary tale that if you get used to thinking the payouts are going to come quickly or they're large payouts, a lot of companies are having trouble finding liquidity exits, monetizing things. Valuations don't show up daily, but eventually you do have to adjust private valuations, and we've seen a lot of them adjusted down and timeframes extended. So to us, it's just a reminder with our own clients of being very clear why you own private equity, why you own private credit or any of these investments, and what you're looking for and what your time horizon is for these investments.
Okay, let's get into Pro Picks, Liz Miller's top ideas. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Liz, before we get into each of the three stocks that you've chosen, is there a theme? Is there an underlining kind of North Star guiding these picks?
It was really that I was trying to suggest from a few different industries where I know there's question marks. And all of these are down a lot. And so that was the other reason I chose them, to talk about stocks that are really far off their peak, but to my mind, still have that very long-term potential and reasons to just take into account, the extreme effect of uncertainty in positions and in areas of our economy that probably are going to do fine once we get that certainty back.
All right, well, let's get into it with Evercore, which is your first one. And true to what you said, that's down 45% since September. So a really swift move to the downside. And it's a financial. What do you like about Evercore?
So we just talked about BlackRock and Blackstone. Evercore's probably a little closer to a Blackstone. This is a boutique firm, M&A firm. They do have some asset under management activity, but they're really looked at for their exposure to mergers and acquisitions activity. And the stock had an incredible run in 2024 as we all were anticipating these lower rates next year and looking for a lot of, we just talked about, this private equity holdings to come into the market. What we have now is an IPO market that's still completely stalled, and this stock has been just slaughtered for that. And for what we've just talked about, I think that once we find certainty, that will come back. 70% of Evercore's revenues are within the United States, so they're isolated and safe from tariffs in many ways as a service company, and I do think we will see future activity pick up. So I think this is a great entry point, very strong balance sheet, $14 billion buyback going on. With a couple of year outlook, I think Evercore's a great buy right here.
Your second one is GE Healthcare, and this one got taken to the woodshed last week. So you're picking it up on a pretty big down move. How much did it drop? Was it on earnings?
It was partly on earnings and certainly the risk with tariffs, some fears of supply chain interruptions from China. This is the spinoff from GE just a couple years ago. I think it was actually just early last year. And it's GE Healthcare. A lot of people don't know what they do. They are the leading manufacturer of imaging equipment like MRIs, CTs, ultrasounds. They dropped like 13% immediately following China's retaliatory tariffs and, an anti-dumping investigation that was started. The company gets a lot of components from China, and at the current tariffs being talked about, the company thinks its margins would take maybe a 10 basis point hit, which is not that bad. But obviously, analysts are thinking it's more than that. What I love about this company, and I said I would talk about AI, I think where you're really going to see AI make a difference early on is in companies like this. They are working to incorporate even more AI into the software of these machines so they can just transform diagnostics and give even more precise outcomes and solutions that become very personalized therapies. I think that we are going to see AI in a lot of healthcare equipment in a transformative way before we see it other places. So again, I think you need a couple of years outlook for all of these, but I think it's a time to swoop in to GEHC.
So you're right. It was the spook was in beginning of March when it was all about tariffs. It dropped like 16% on the one day, and it actually reports results on April 30th. so you're talking about getting in front of a stock, maybe ahead of those earnings. When there are these tariff concerns, what can the company say? What do you expect the company to say that could potentially provide some support to investors? So not so support, maybe some comfort to investors.
No, I think all of these companies are going to have a really hard time speaking to any type of guidance because GE for healthcare, for example, of course, makes these incredibly expensive machines. So there's two questions that we have for what their future looks like in the near term, because we think their customer is equally uncertain and probably is pausing some of the purchases. They may talk about a backlog of orders that are being delayed. So that won't be surprising because just as we talked about people stopping to buy, not buying their Sweetgreen today, corporate executives are holding off making big purchases as well. They're under the same uncertainty, if not more. But it would be nice if they maybe give some guidance, if they have any, on, how much of their supply chain is at risk or what they're doing to think about their supply chain in a higher tariff environment. I think that will give the analysts who are really tearing this apart, more information to be thinking about the long-term opportunities for them with their equipment and with the global general demand of their equipment.
Okay, your third pick is Carlyle Companies, not Carlyle Group, which is the private equity. So Carlyle Group is ticker CG. That's not what we're talking about. We're talking about Carlyle Companies, ticker CSL, and they do something very different. What's the play?
So this is in the construction area, and that's another area that, of course, has really been hit. I mean, the homeowners have been devastated, home builders, excuse me. Carlisle Companies is in an interesting niche. They do roofing, but they really do highly engineered roofing and waterproofing. They are definitely being hurt by slowdown in commercial construction, but they also do a lot of work in retrofits and repairs. So that's going forward. And so even as homeowners perhaps aren't buying the next home, then the current homes and the current buildings need more maintenance and they have exposure to that. So that's great. This is another unique company that while they had been actively working to expand globally, 90% of revenues still come from the United States. So now we're talking about a play that's about tariffs on the supply side, but more so about interest rates in the US for their end markets. They're going to report just this week on Wednesday before the open. So we have just a couple days there. They're trading, at about 16 times this year. The stock is down a lot from 480 to around 350, another stock that's been devastated. But again, a stock where we think the product has pretty consistent demand and lots of upside. And once this uncertainty is settled, there's a big piece of that downside that will immediately go away.
There is, I think, a lot of depression around home building in general, and even results from D.R. Horton signaled that, it's not brightening up anytime soon. Orders are down huge, and just with rates remaining elevated, Americans just aren't moving. So is this a bit of a more longer term story? Like, you don't expect this story to inflect this year, do you?
So I think Carlisle is in a unique position where part of their business will start doing better as soon as we know the tariff situation. But yes, the real upside then comes as a second piece of good news once construction takes off. Carlisle did very well last year, even while we still knew we had high rates and a low construction environment, and certainly, moribund home building. So it has other exposures, particularly, as I said, with the retrofits, the fixers, where there's got to be a lot of roof replacement. And that's the part that's been so stalled with the tariff uncertainty.
Liz, it has been such a pleasure. Thank you so much for joining us and bringing us these ideas.
Thank you so much. It's been great to talk about them. It is a really uncertain environment. I think we're getting almost upset with hearing that word yet another day. But from portfolio managers to consumers to business leaders, nobody can commit to the next move until we have some more visibility on negotiations one by one as they actually get firmly finished. and the big guys, China in particular, but Canada and Mexico. I'm hopeful that we get some completed negotiations there soon. I think those big three will go a long way to allowing investors and consumers to start moving forward.
That's a great note to end on. Thanks so much. That's Liz Miller joining us from Summit Place Financial. Don't miss our next episode. This one was all about U.S. stocks. Our next one is all about Canadian equities. We've got Gary Aiken on the show of Franklin Templeton. If you've got questions about your Canadian stocks, you can email us at questions@inthemoneypod.com. You can go to our website, inthemoneypod.com, and submit a question there, or hit us up anywhere on social media at In the Money Pod. And we'll see you on the next episode.